Ed Yardeni of Yardeni Reseach calling Warsh a, quote, hawk in dove's clothing, writing, we thought he was a dove who favored lowering the federal funds rate. Instead, he hammered home a strict orthodox message on inflation with a strong commitment to price stability. Ed joins us now for more. Ed, great to see you. Thank you for being here. So is this more of an Alan Greenspan rather than, say, an Alan Burns?
I really can't answer that because I have a task force working on that.
Don't we all?
It's very Greenspan. I mean, it's, you know, not a lot of information, a lot of ambiguity, and, you know, occasionally some surprises. He started right off the bat with a surprise. You know, it's kind of like he had an interview with President Trump and yesed him, told him everything that he wanted. Yes, we're going to lower interest rates. Yes, AI is creating productivity. Then as soon as he got the job, it's like the old Warsh concerned about price stability. He mentioned price stability over and over again. And not only that, but he pretty much committed to 2%. He didn't finagle that too much at all.
Mike Reed of RBC said, by their count, inflation was mentioned by Kevin Warsh 19 times compared to 4 times where he mentioned the labor market.
Right.
Is this...
And the labor market's looking good.
Right, exactly. There was no mention of dual mandate or a sense that maybe there's some weakness there in conflict in the dual mandate. Is this all talk and not action, right? I mean, if you were skeptical, you would say this is somebody who wants to jawbone the market. You're seeing the move that he wanted in the flattening of the yield curve. And then he won't necessarily
Well, I think he's hoping that he'll be lucky because so far so good. I mean, the price of oil's coming down. As you mentioned, the price of gasoline's coming down. We are going to see the headline inflation news coming down substantially. And if he's lucky and the recent inflation surge doesn't spread into the rest of the inflation numbers, then he may very well just kind of sit back and let that all happen. And then he'll say, well, look, you know, things are going in the right direction. We don't have to do anything. And at the same time signal that down the road maybe the productivity story will come back as a reason to lower rates. But right now, it may be a do-nothing Fed for a while.
What if we see a labor market that does weaken, though? What's his reactionary function going to be?
Well, he kind of locked himself in. I mean, you know, he didn't say very much except on price stability. He said that over and over again. And I think that if you get a weaker labor market, he's going to be called on if he suddenly becomes very liberal, you know, in the mandate and says, well, people are getting hurt. We've got to focus on the unemployment rate. He basically said that in order to have a healthy economy, in order to have a healthy labor market, you have to have a price stability, which, by the way, is deja vu all over again, because that's what Powell had been saying for quite some time.
Do you think he was the one that threw out the proposal of discussing a rate cut at the meeting, just so he can, you know, when he has breakfast with the Treasury Secretary, say, look, I threw it out there and I was pushed back?
We don't know. I mean, you know, it's a good conspiracy theory.
Right, could work.
It makes sense. You know, you could go back to the president and said, hey, I was the one who, you know, well, but he said he didn't vote on the dot plot, so, you know, I don't know where he is on all that.
So when you take a look at some of the projections coming out of a number of different Wall Street houses, some have been raising their expectations for a rate hike this year. You saw that with Deutsche Bank saying that with less communication, they could be more nimble and hike rates sooner. Even Citigroup, which has been on the more dovish side, pushing back the potential for a rate cut. If there are rate hikes, does that curtail the roaring 2020s and some of the enthusiasm that we're seeing in equities?
Yes,
your story. Yes. So does it affect it?
Last time I was here, I think John mentioned that we were 6 years into the roaring 2020s. If you just count it, we're actually 7 years into the roaring 2020s. And so if I get this year right, I only have 3 more to go. And every year there's, you know, it's a roller coaster ride. You get all sorts of things to worry about. Maybe that's the next worry, is suddenly we're worrying that, you know, if the Fed actually has to raise interest rates, then won't that spoil the roaring 2020s, the party we're in? And I don't think so. I think the economy has demonstrated its resilience. You know, people have been kind of getting all bent out of shape about the bond yield being back up, but it's back to 4.5%. That's kind of normal. I think the bond yield is normalized. I think Fed policy is normalized. I mean, I think Warsh can just kind of leave things alone here for a while because the economy is performing just fine.
Those are two different things, though. Leaving it alone versus hiking rates, two different things.
Yeah.
And understandably, people are watching what he does, not what he actually says. At the same time, if you do think about hiking 2 times this year, which even Bob Michael of J.P. Morgan was talking about yesterday, how much does that infect potentially some of what we're seeing?
Look, when the payroll numbers came out real strong, we kind of reiterated our position that there was not going to be any rate cuts this year, and that the Fed would probably switch to a tightening bias at this meeting, which is exactly what happened. They didn't go from an easing bias in April to a neutral bias. They went right to a tightening bias, and so we got that right. But the thing that really surprised me is how hawkish that Warsh came across. If the Fed were in a position where they had to raise rates, it'd be a quarter, 50 basis points. It wouldn't be a big deal, in my humble opinion. And the bond market might actually rally on that. Back in 2024, when the Fed lowered the Fed funds rate by 100 basis points, I said, I think you're making a mistake here because the economy is resilient and you haven't gotten down to 2%. The bond market agreed with me, my bond vigilante friends. The bond yield went up 100 basis points. And even last year, they cut 75 basis points on the Fed funds rate, and the bond yield, where is it today? 4.5%. So they haven't accomplished anything. So lowering rates hasn't helped, but they may conclude. Look, the thing that really came across to me is that, and he said it, Warsh said, look, we haven't gotten down to our 2% inflation target in over 5 years. And he said he committed the committee to get down to, get inflation down to 2%. So, how are you going to do that without raising interest rates? So I think the market's got it right now, when we thought that there would be a tightening bias, and there could be an increase. If the Fed really wants to get it down to 2%, that may be necessary.
But Ed, what about the Fed policy on the housing market? Because he said that's one area where he does think it's restrictive.
Well, at the same time, he's talking about reducing the balance sheet and particularly focusing on, the Fed's been talking for a while about reducing the mortgage-backed securities down to 0. That's not going to help the housing market. I don't think they've got an answer for that. It's a shotgun. It's not a rifle. There's only so much the Fed can do. I'm a believer that if the Fed is not in our face as much as it was when Powell was around, I really don't mind less communication. I fondly had been calling them the Federal Open Mouth Committee.
Well, are you on the task force? Any
No,
of the
I'm
task
not
force?
on the task force.
This is my first question to everyone. Are you on a task force?
Yeah.
Which one?
Yeah.
Ed Yardeni, thank you so much for being with us.